Hi, everybody, and welcome. We're going to give a couple minutes for people to join, and then we'll start. Okay, maybe about 30 more seconds, and then we'll get going. Okay, everybody, welcome to the webinar. Today's topic is transforming your payment reconciliations with automations. The presentation should be about 25 to 30 minutes at the most. We will have a Q&A at the end. So if anything piques your interest and you want to know more about it during the webinar, please write in the question and answers box. And at the end of the presentation, we will have time to get to some of those. And to make it more interactive, we may have one or two polls throughout. My name is David. I'm a senior technical specialist here at Solvexia. I've had quite a bit of experience with payment reconciliation solutions, and I'll be taking you through today. So what's on the agenda? First, we'll start with a bit of an introduction into the payment landscape. Then we will look at particular business challenges of the growing and developing payment world. I want to focus on a case study so we can make it more practical and more tangible with a real example of a company that Solvexia helped automate. And then we will look at how to create opportunities for your business through automating. And finally, once the idea of automation has been laid out, we'll focus on what to look for in an automation tool. Let's get a sense of the landscape. As you can see here, the first study on the left, I hope you can see it, is from McKinsey. It's charting the total payment revenue globally, which is $1.9 trillion, at least it was in 2020. And by the end of 2025, the expectation is that will be $2.5 trillion. So it's a massive arena, and it's growing quite rapidly. It's growing about 7% annually. The chart on the right here is from PwC, looking at the instances of global cashless payment. And the expectation is that cashless payment is going to increase by about 80%, which is unbelievable, between 2020 and 2025. Obviously, large cell phone payments is a huge driver for that. And if you can see it, it's a bit tricky, but the area of globally that has the highest adoption and the most growth is the Asia Pacific area. So particularly for us in New Zealand and Australia, we're in the hot zone. So what's contributed to this growth? The first thing is the rise of e-commerce. Not that it hasn't been around for a long time, it's just that things are accelerating. One of the big accelerators or causes of acceleration is COVID. During lockdowns, so much commerce moved to the online space, particularly retail, and that really was a big driver. And even now that we're open again, a lot of the businesses and a lot of the traffic that was pushed online stayed online. So that was a big cause. And finally, fintech solutions. There's a world of innovation happening now. Different ways for people to buy, different distribution channels. A classic one that Australia is kind of the global ground zero for is the buy now pay later space, but that's only one example. There are so many micro lending and other fintech solutions that are sprouting up and having a real impact in the ecosystem. So with all this happening, what are the business challenges? First of all, there's a huge influx in payment service providers and more third-party vendors. In some cases, we here in Sovexo, we work with a company that has 20 to 30 different payment channels now. So rather than the good old days when it was just cash or cash and credit, now there's buy now, pay later, as we mentioned, and there's Google Pay and Apple Pay and a whole plethora of different options. That's a real challenge for a company to deal with. The second thing is that the technology for the back end usually doesn't match the rate of acceleration of the front end. So the front office of a company is always thinking about how to expand and what new frontiers can we expand to and reach and tap into. So there's always an attacking mindset, and the front office is driven by sales, but the back office is oftentimes left to figure out how to deal with that. And that can be a real challenge for the back office accounting and finance teams to keep up with the growth and particularly the technological mechanisms that the front office part of the company is working with. And finally, a lot of the ERPs that companies are using lack the functionality that are required these days. When these ERP systems were built, it was just a different payment landscape. So a lot of the functionality that's needed is not available. And there's a lot of companies going through ERP transitions now, having become aware of that problem, particularly a lot of moving to the cloud. But even with that, there's a real mismatch there between the ERP's functionality and what is required. So what's the business impact of all these things? The first thing is cash is king. Nothing is more important in a company. The management of cash and cash flows is always extremely important. It's also stress on the accounting teams. This is time that could be focused for much more valuable activity in terms of the development and vision of the company. It's a huge revenue opportunity. It's somewhere around $100 billion plus at the SME level. And there's just tremendous opportunities now for distribution and for connecting with customers and accepting payment through all these new channels. Another one that's important to mention is fraud revenue loss. A lot of these technologies are new, and with them being new, the systems are not in place to catch people who are abusing them, and there will always be people that are using technological advancements for evil, just like they can be used for good. So there's a lot of people abusing that, and a lot of fraud, online fraud, that's happening through these channels. Another important business impact is client relations. So the way that you communicate, the way that a company communicates with customers, with partners, who you're distributing with and need to reconcile with, it can be a lot of a back and forth. And the more professional, the cleaner the data, the easier it is for all parties, and the less it's going to cost. Another important one is treasury support. So a lot of treasury departments are moving from what's called a custodian model to a strategic approach. So the better systems that are in place, the more information there'll be for these treasury teams and cash management teams to make strategic decisions. And finally, audit and compliance risks. The more spreadsheets and the more everything is disorganized, so there's more audit and compliance risks. And when we have things that are recorded, it can be really, really helpful in a compliance level. That's a bit of a background. I want to transition and just talk about a case study because I want to make it practical. So let's just have a look at a firm that Sovexo worked with, which is Emma Sleep. Emma Sleep is based in Germany. In 2021, it was named the fastest growing startup in Europe. They're in 21 different countries. They sell both in-store and online, and they're leveraging a lot of different channels to sell their products. So they're selling through Amazon, and on their website, you can pay with buy now, pay laters like Zip and Klarna, and PayPal, and Google Pay, and classic credit card. So they're really, if you can imagine the accounting and finance aspect of that business, it's really, really a lot of growth and a lot of data and a lot of complex stuff going on. So we'll come back to Emma Sleep a bit later. I just want to focus first on some of the classic issues when we're thinking about reconciliations. And there's really four major issues. The first one is different data formats. Trying payment reconciliations often involve consolidating and reconciling across different data formats. And this is a real challenge. One classic example of many we could choose from is date formatting. So if you've been in finance long enough, you know the dates come in it seems like an infinite variety of formats. There's hyphens, there's dashes, there's words, there's numbers, there's one number, there's two numbers, there's four numbers. It's a real headache. And that's all before we get to the complexities of different international standards and different international ways of expressing dates. As a parenthetical comment, I am an American living in Australia, and some things about Australia have been hard to embrace, like Vegemite. But I will say that two things have been great. One of them is the metric system, which is incomparably superior to the imperial system. And the second one is the date formats is actually much better here. In America, they do months, days, years, whereas here, obviously, the date format is days, months, year, and it just makes so much more sense. You go from the smallest increment, which is days, up to the largest, which is months. Which is years. So days, then months, then years. Just makes so much sense. Anyways, close parentheses. Date formatting, especially for an international firm, can be a huge headache. Other examples of different data coming in different formats might be currency differences. So values could have different currency symbols, and if we want to get some sort of equivalency between different currencies, we might have to do a manual manipulation of the data based off the exchange rate, which can be really tricky. A third one that I want to mention when it comes to data formats is transaction identifiers. Sometimes transaction identifiers are present, and sometimes they're not. Sometimes we need to do some sort of special concatenation to develop one of a couple columns. Sometimes a data source will have multiple identifiers that map onto multiple other data sources in a complex way. So, these are all examples, and there really is no shortage of difficulty when it comes to data coming in different formats. And inconsistent data formats means an accounting team spending a lot of time doing repetitive data manipulations, which is a huge waste of time. Second issue I want to touch on is timing differences. So when a finance team is dealing with a bunch of different data sources, invariably we're going to have timing issues. Let's think of an example. For example, let's think of an online retailer who has an ERP system that records transaction sales down to the second. And they're trying to reconcile with payment provider data that captures the same transaction a few seconds later. And let's say sometimes that gap is not consistent. Sometimes the payment provider will capture the transaction 2 seconds after the ERP does, or 5 seconds, or 8 seconds. So it seems like a small thing, but when we're trying to be really accurate, and so the accounting team is going to have to account for that variance, and it can get really tricky. It get really tricky to match things up. For example, if there's a transaction that's close to midnight on the ERP side of things, that transaction will be recorded as happening in one day, and on the payment provider side will be recorded as happening in another day. So all those kinds of that's an example of a timing issue that can be a real issue for reconciliation. Let's take another example. Let's say the same online retailer has a reconciliation between their bank statement deposits and a bulk settlement with the payment providers. So the timing of that can vary on either side by a couple of days, and that makes it a little bit difficult and tricky to match the two data sources. Particularly, let's say if there's an error, and for whatever reason the statement, the deposit and the settlement are not showing the same value. And then add other complexities like that happen near the end of the month when we have to do reporting. It's a real problem. So these lagging time differences and different transaction times can be a real difficulty to deal with and need to be thought of. And a finance team can really waste a lot of time and resources dealing with these difficulties. A third one is complex data matching. In a perfect world, at least a world that would be perfect from an accountant's perspective, all reconciliations would be simple, be one-to-one, and they would use a clean, reliable, unique identifier. I hate to break it to you all, but the world is not perfect, and data matching is often quite complex. The identifiers are often not clean. They're oftentimes not even a single field, and sometimes they're missing entirely, and we might have to make one up. Really difficult stuff. An additional complexity, by the way, is data existing at different granularities. So let's imagine a reconciliation between store totals with transactions for that store. So one data input will have totals based off of the store, let's say daily totals, and the other side will have all the transactions. And in order to do a proper reconciliation, we need to first sum all the transactions of the given store. So that's already, we have to step into the world of aggregating data, which is opening the door for us to make a lot of errors. Depending on how complex it is, it's going to take a lot of time. And that's a real complexity. And the fourth one that I want to touch on today, and the final one, is the growing number of transactions. So as transaction volumes increase, so the data, the amount of data we're reconciling increases. And we're famously in the big data age. We're not talking anymore about bookkeeping for a mom and pop store. These days, it's not at all uncommon for a business to be working with millions and tens of millions of rows. So when the size of the data increases, it prevents us sometimes from easy solutions. Non-technical workarounds that were effective for 1,000 rows of data are oftentimes futile in a data set of 100,000 rows. So let's imagine an example. Let's say there's a data set where there's a column of text that comes in and it's dirty. It's not clean. And we need to clean it up based off a number of different criterion for that text. So for 1,000 rows of data like that, it's annoying and it's time consuming, but a couple hours of focus and grit, and it's a doable problem. When you take the same instance, but it's 100,000 rows of data, so that kind of manual solution, which we rely upon, actually stops being a viable option altogether, and we're stuck. And it actually forces us to think about new ways entirely to approach the problem. One final point on the growing number of transactions is that it's a problem in itself, as we just discussed, but it actually also exacerbates all three of the previous problems. So performing data transformations, implementing timing corrections, and matching complex data can go from bad to terrible when our data gets to astronomical sizes. Okay, that's the end of that first part. I want to switch now to a poll and get a sense from the audience. What is your biggest reconciliation challenge? Is it different data formats? Is it timing issues? Is it complex matching rules or growing number of transactions? Or if there's any other that we didn't mention, you can pop other in there. Can I just give a couple more seconds for people to fill out? Okay. So here are the results. It is 43% said complex matching rules. So that's the biggest one. And then growing number of transactions. Very interesting. One other. We'll have to, whoever the other was, maybe write in the question and answer box what it is. I'd be curious to know what that is. But anyways, interesting to see. Very interesting results. Thank you guys for participating. And good to know. 43% complex matching, 29% growing number of transaction, 14% different data formats, 10% timing issues, and one other. Alrighty, so keeping going, let's circle back now to Emma Sleep. Emma Sleep is a Emma Sleep is again, it's a mattress. They sell mattresses and other sleep bedding type of things. They are in 21 different countries around Europe. They're in Australia. They sell in America as well. They grew tremendously quickly. They have several ERP systems. They sell in-store and online. They have a bunch of different payment providers. So they sell through Klarna and Zip and PayPal, ShopPay, Google Pay. They sell through Amazon. And interesting to note that Amazon in Europe is actually not one unified entity, but it's several different entities. So each country that they're selling in through Amazon is a whole separate different entity. Their process that we helped automate was 80 different file formats. So it's a huge process. Obviously, they're dealing with different currencies from different countries. They're dealing with different date formats, as we mentioned, both based off of the location, but also based off of the formatting of the provider, different column layouts for different provider spreadsheets, and huge volumes of data. So this is a really, if you think about it, a really complex problem that mentions a bunch of the issues that we just discussed together. So what did the solution that we automated for them have? Let's just focus on two examples, hopefully for everyone to get just a bit of a sense of what automation can do. The first one is column mapping. So these 80 different files from the different payment providers and different data sources were coming in and had the data was in different columns. Collating all the files and adjusting the columns so that the data is appearing in the same columns is a huge help for the financial process team. For example, the last column here is a settlement ID. If you can see that all the way to the right. So that column in any given spreadsheet would have been in column A, B, C, D, whatever it might be, F, Z. And through automation, we can actually make the settlement ID for each of the inputs be in the same column. If you can see there, the column name for each of the files was different, even in different languages. But by using an automation technique, we now have all of them aligned into one column, and that can be really useful if we want to do a reconciliation based off of settlement ID, based off of a bunch of different payment providers. That's going to speed up the process, and it's going to make it more reliable and accurate. Another solution is with the formatting. As we mentioned, with dates can be very tricky. So there was an automated date formatting solution in place, which took into account the date format of a given location and also of a given payment provider, and standardized it. So after the process, the automation had run, all of the dates were showing up in the same format. This is obviously hugely helpful if we want to be consistent and we want to have a consistency from a financial accounting perspective across all of our different inputs. In addition, we were able to implement some timing rules for them. So if something comes in as a little bit earlier or a little bit later, that was also allowed to be accounted for. So again, what are some of the outcomes of these solutions? So it's efficiency gains. This is a process that originally took 4 to 5 people down to 1 to 2. That's now freeing people up. Instead of doing those tedious and monotonous data manipulations, it's now freeing people up to do higher level tasks. So the finance team can now spend time doing that forward thinking and proactive work that everybody wants to spend more time doing. It's especially important, by the way, for smaller teams that have limited resources. We're being stuck in the mud doing those repetitive tasks. The boring tasks can really hinder the important creative and growth-oriented work. The second outcome is streamlined. So the process is clean now and it's easy to understand. And that's really important because it increases the transparency of what's actually going on. Rather than oftentimes in a finance team, you have a black box between the inputs and the outputs, and no one really knows how we get from A to B. And that's particularly useful as a manager. So if you want to come in and just have a bird's eye view of a process and get a sense of how the process is working, you can do that now with much greater ease. Another really important thing to note here is that it eliminates key person dependencies. So a lot of times a process is just sitting in one person's head and we don't really know what's going on there. And by making it explicit and putting it in an automated step, we can audit that process and we can make sure that it's correct and it's out in the open, which is a really helpful thing, especially when working with a team. Another thing is scalability. So now when MS Leap has an expansion opportunity, they don't have to worry so much about whether they have the back-end financial resources for the added load. With this automated process in place, it's very easy to add another payment provider on top of the existing ones without a huge increase in time spent and or resources. And that's really important because it allows the business to shift into an expansive mindset. They don't have to worry if they're going to be able to keep up. They can just look for opportunities and be confident that they can grow into those opportunities. Another thing I want to mention is data quality. Simple as the following statement, which is the less human involvement means less errors. So whenever we can automate a data process, we can have increased confidence that the quality and accuracy of the data that's coming through is going to be improved. Final point, just on the bottom left here, is integration. At a certain point in time, Emma Sleep switched to a new ERP, and because the whole process was automated, it was a very easy transition for them. And that gives a business amazing flexibility and dynamism and the ability to pivot, which can even mean the difference between life and death of a company. So that kind of ability to pivot and ability to integrate is really, really important. Okay, so we've discussed up until now some the benefits of automating, the problems that are facing the payment ecosystem now, and the benefits of automating some of those processes. If the idea of automation is appealing to you, I just want to take some time to think about what a good automated reconciliation tool will possess. The first one is that it can handle all of your data enrichment, timing, and matching rules. This includes being able to work with any data you throw at it, blend data together, persist data for timing differences, and do all of the complex matching that you need. For example, if a solution is able to handle only 50% of your needs, or it can ingest only a certain type of file that you're working with, it's not really going to deliver the benefits that we saw above. Another important thing is for workflow capabilities. The best automation tools will be tools that don't force you to dismantle and then redesign your current processes. The automation tool should be adapting around your process, not the other way around. And so most processes as they involve teams of people and probably a hierarchy, and workflow capabilities, the ability to send reports automatically for review and approval, is really, really crucial. As an addendum, the automation tool, if it has and can capture an audit trail of these reviews and approval, it's even more valuable. That can create a really healthy sense of transparency and accountability within a finance team. Third, you need flexible reporting capabilities. An automation tool that's excellent at crunching numbers and data, and then is limited in what it can report on the output end. It's not all too useful. So you want to make sure that your automation tool can produce the ideal output for your process, whatever that might be. That might be an Excel file, it might be CSV, a Word, PDF, could be an interactive dashboard. In some cases, you might need a connectivity to your ERP system that can post a journal. Whatever it is, you want to make sure that there is flexible reporting capability. The fourth thing is the ease of use. This is a really important one, particularly given that most people who are doing reconciliations are very business focused and time poor. So you need solutions that don't require any programming and that are drag and drop. For ease of use, it's really important to find a no-code, low-code solution, one that's agile and has an open platform. Something, the way that I like to think about it, that's understandable for the average intelligent accountant. You want something intuitive. You don't want something that's going to be dependent on a team of electrical engineers if you want to make a change. It's not what you want. Finally, following from the previous point, you want a solution that is a low cost to set up and that's easy to maintain by the business and not by an IT team, as well as good support and expertise from the vendor. Ultimately, we're looking to make good business decisions, and there's always a bottom line. We're always trying to earn more money, so anything that's too costly is going to be counterproductive. So this is basically just a summary slide here. This is how one can think about automation. You have your inputs on the left, whatever they might be, in this case, payment providers, an ERP bank statement. In the middle, you have the meat and potatoes of the process, the data ingestion and the validation, the matching. And on the right, you have your outputs. You have your reporting and analysis, your audit trails, alerts and approvals, and collaboration. And that is payment reconciliation automation in a nutshell. I want to run one more poll for everybody. And the poll is as follows. What are your automation plans? Do you have no plans to automate? Are you considering automation for the future? Or are you actively looking for a solution? And I'll just give half a minute or so. Okay, a couple more answers trickling in. Okay. Okay, so We have one person here who's not planning to automate. I wonder if that's the same person that had a unique problem. Uh, the bulk of people are considering automation, 71%, and then 24% are actively looking for a solution. Okay, very good to know. Okay, guys, so that's really it. I just want to finish by saying we'll switch to a Q&A, but just one final thing is that we recently published an ebook on our website about payment reconciliations. It's got information and some case studies like the one we described in MS Leap. The URL is right here on the slide, or you can always go to the Solvexia website. So yeah, feel free to distribute this ebook throughout your company if you want to build some momentum or gain interest from management. Ebook could be a great tool to do that. And finally, please feel free to contact us for more information. If you want to learn more about payment reconciliations, or if you'd like a demo of our product. We also, if you'd like us to come into your company and understand your business pains a bit more, we can do that. Sometimes we'll do a POC based off of an actual financial process in your company, so you can see what an automation solution is in a very relatable way. So that's always an option, and please feel free to reach out to us. Thank you very much for tuning in. I'm gonna have a look at some questions that people asked, and let's see what there is. Okay, so one question here is, does Solvexia integrate with other payment platforms or payment providers? Yeah, so Solvexia as a platform is quite advanced in how it can accept files. So we can take flat files. It can take ingest API. We can work with APIs and secure FTP capabilities, connectors to lots of other systems like ERPs. So we have lots of ways of grabbing files that are intelligently and automatically. Are Solvexia's web services web-based, or do you have local reps in certain centers? Yeah, that's a great question. Our services are mostly web-based. We're based out of Sydney, and we have an integration team here. We've also got representation in the UK and a couple other countries. And yeah, we usually work with a client to help them develop a solution. Any other questions? All right, looks like that's it. Thank you everyone for tuning in. I really appreciate it. Hope you enjoyed. And thank you very much.